Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Q&A, Friday Q&A. Go online and tell us how you were pitched an annuity. Hey, Q&A, send the sharks away. If your broker tries to sell you junk, just run the other way. All right, I'm not a professional singer. I threw that together in like 10 minutes, but I thought it was a nice way to start a seasonal Q&A, even though there's no seasonal theme to the Q's or the A's, unless I, of course, try to make one. It is December, and therefore 'tis the season for corny little ballads like that. Hi, everybody. Don McDonald here on a Friday in December, taking your multitudinous questions on a holiday Q&A episode. So thanks for all those. We're going to do a bunch today. Some of them are really short, but we've got a bunch. And that's a good thing. It's a holiday bounty, or you get a holiday bonus or some holiday thingy. Thanks for tuning in to the podcast. It's called Talking Real Money. And on Fridays, we answer your questions. You send them in to us at talkingrealmoney.com on the contact form. And if you speak them, like you'll hear everybody doing in this episode, they end up on the Friday Don Answering Questions podcast, which is what this one is. Thanks for being there. Tell a friend, and let's get started with the questions that were sent in. Here is the first one.
Don, I was listening to some of the back catalog, and I heard you mention that you changed your insurance from whatever corporate insurance to Medicare. I was just wondering if you could give us an update on how that went. For my own mother and an older friend I know of, they both have struggled with their Medicare Advantage choices. I'm just looking to learn from your experience. Thanks.
Well, you won't really learn from my experience, but from my research, because I remain with Apella's company insurance through United. But I did look into it because I'm old enough for Medicare. But I am not a fan of Medicare Advantage plans because I've experienced the nightmare it is dealing with private insurance companies. They're a pain. The pre-authorizations and just the rigmarole, the hoops you need to jump through. So I did look into Medicare as an alternative because I'm paying a premium. I pay a portion of the premium for my private health care. And when I crunched all the numbers, regular Medicare Part B, D, and a Medigap to get me in line with my current policy would have been almost twice as expensive, and that's due to some capital gains I'm incurring that would kick me into ridiculous IRMAA territory. So IRMAA killed me. IRMAA just killed me. Once I get past these capital gains, then Medicare at 2 years past, because I got the 2-year look back. Once I get 2 years past those gains, then my Medicare premiums will be far more affordable. I'm probably at some point going to have to bite the bullet and pay the big IRMAA premiums, but I would not get Medicare Advantage. I have heard too many horror stories. I have had a really pretty awful experience at times dealing with private insurance. United can be a pain in the neck. They really can, because remember, they're all about the profit. I'm not going to sing all about the profit. But no, I'm not going to do that. But they're about profit. They're a for-profit company. So they have to find ways to not pay so they can make more for their shareholders. I get that. but as a patient, I don't like it. So I didn't do it, but it was regular Medicare with IRMAA can get pretty pricey. Thanks for the question. Send yours in at talkingrealmoney.com. Well, actually, speak them in at talkingrealmoney.com. And let's go to the next.
Hello. My question is regarding my mom. She's 82 and she has about $300,000 in a taxable brokerage that's been actively managed for several years. I'd like to close that and move it to something. She doesn't need the money. We just want to preserve it. So I'm wondering if I should simply put it in a high yield savings or something else. Thanks.
Well, if it's all about the safety, I did it again. If it's all about safety, then I would not go with high yield savings, because while their yields look good today, if interest rates fall, the rate immediately falls on high yield savings, or almost immediately, very, very, very quickly. I mean, we could see high yield savings accounts go from nearly 4 to 0 in months if rates really plummeted. So it's a risk. That's why I believe in diversifying that risk away, even in a fixed income portfolio. And there are a couple of ways to do that. One is to own just a bond fund, a simple bond fund like Vanguard's Total Bond Index, BND. It will fluctuate a bit in value, but it generally is likely to preserve your principal pretty well. I mean, we've had really, in the entire history or the last 100 years of the bond market, we've had 1 year where bond yields really took a hit, and that was 2022. So generally speaking, something like BND could be very good. And what happens with that is they're not all just short-term instruments. There are intermediate and even slightly longer-term instruments, so that if rates fall, they've got other securities paying higher rates from the past. And if rates rise, they've got new securities coming in paying those higher rates. The other slightly more complicated way to accomplish something similar and to give you the feeling of almost absolute safety is to build a secondary market CD ladder. And you can do that through most brokerage firms. You buy a 1 year, a 2 year, a 3 year, a 4 year, and a 5 year CD, along with whatever money you need for emergency purposes that's in the high yield savings or money markets. Then every year, this is the tricky part, every single year when that 1 year CD matures, you must keep the discipline. You must immediately, or as quickly as possible, buy a new 5 year CD to maintain that upper rung of the ladder. And if you guys can do that, great. If not, I'd probably go with a bond fund. I might go with the BND. I might look at a Vanguard intermediate term Treasury, which is likely to be inherently just a little safer and a little less volatile. So look at those options. If this is truly money she doesn't need to grow, she just wants to keep safe and maybe spend it someday. Who knows? Thank you very much for your question. And let's get our next question.
Hello, Don. I've been helping out my wife with her 401k. My wife, who's 34, is currently 100% invested in the Vanguard 2055 Target Date Fund, which contains 8% bonds. We've been looking at moving out to a later target date fund like 2070. However, it's the same bond percentage. So in light of that, we're looking at selling all of the target date funds and moving to a Vanguard 3-fund portfolio through her work. Her work's 401k provides the S&P 500, the Extended Markets Fund, and the Vanguard Total International, all at extremely low costs, and was looking at your thoughts on selling that target date fund and buying the 3 funds through her work's 401k. Thank you.
If your goal is getting her to a 100% equity allocation, sure, I can see doing that. But the trick is managing it. The most wonderful thing, I'm feeling Hakuna Matata coming on now. I'm in that kind of mood. The most wonderful thing about, or I could do the Tigger thing. The most wonderful thing about Tiggers. The most wonderful thing about target date funds is the glide path, the regular rebalancing. So, yeah, the downside is Vanguard feels like you should always have about 10% in bonds. And they don't have any value or small tilt, which if all was equal, we'd like to see, but you're not going to get that anyway. However, adding the extended market does up your small cap ratio a bit over the total market. So I guess I could see doing it as long as you're okay with the regular rebalancing that's going to have to be done. Otherwise, the big difference between the 2070 and the 2055 is not the initial allocation. They're going to have almost the same. It's about 90-10. Actually, it's like 91-9 in 2070, but it's really close. The difference is the rate at which they change. The 2070 will move much more slowly toward bonds over time than will the 2055. That is really the biggest difference. So if you want to DIY it, great, DIY it. Those are great funds. They're inexpensive, and you're going to be 100% equities. Bear in mind, you're going to be 100% equities. Bad market could mean a 50% hit. But if she's still contributing, then you're buying on sale, which is what you should think when you're in the accumulation phase. Shouldn't worry about down markets. They're actually really good for you when you're accumulating because you keep adding money at lower prices. Thank you for your question. We've got another one, though, on deck. Well, it's not on deck anymore. It's at bat.
Hey, Don. Happy Friday. I was just wondering if you could help me add 10% to my portfolio of either AVDS or AVDV, both international, small cap. I'm not sure what criteria I would use to decide. Thank you.
Well, in this case, it's more like grapefruit and oranges. There's a difference. They're not the same. It's not a binary choice. AVEV is emerging markets. AVDV is small cap value. International. They're both international, but international small cap value is going to be in developed markets. In other words, Europe, Japan, Korea. It's not going to be investing much, if at all, in emerging markets. AVEV is all emerging markets. So they're two really different portfolios, both with a small cap and a value tilt, but they're buying dramatically different stocks. So I think the correct answer is both. Buy both. If you don't have an emerging markets fund, you probably should have one. If you don't have a small cap value fund, you might want to have one. So I think the correct answer is splitting the money and putting it in both because they're different. You really should have exposure to both asset classes. All right, we got, let's see, do we have one more or two more? Look at the time. I think we can do two more. Here's the next one.
Hey, Don and Tom. Quick question for you. I am a high school math teacher, and I work with a lot of students in what we have as an investment club at school. I have many kids, very young kids, 15, 16 years of age, wanting to get started with investments, and I do counsel them in that area. But what I'm asking for is what sites do you use to track stocks, to research stocks, to watch portfolios? I use Yahoo Finance myself, but the free site gets really cluttered with ads. Other students use Google Finance. I don't mind paying a small fee myself for tracking a site, but for students, I'd like to have something that's free for them to analyze. And I'd like everyone to kind of use the same site so we can find things quickly. I know you use Morningstar yourself. Is their free version pretty adequate? Or which sites would you recommend for newbies, young kids to get started with, just to kind of watch stocks, not actually buy them, but just to track them and do some research? Thank you very much.
Well, I think I have to start with the bigger issue. Are you trying to train these young people to be wise investors, or are you trying to train them to be financial analysts? I'm hoping you're trying to train them to be wise investors. And if you are trying to do that, then you're doing them a disservice. I love that you're doing this, okay? Don't get me wrong. I love that you're doing this. But I think by encouraging them to research, even to just research individual stocks, you're doing them a disservice because you're leading them to believe the great Wall Street myth. And that is, well, if I just have enough information, I can beat the stock market. You can't. beat the stock market as an individual. You just can't do it. The only people who do it are lucky. And when you've got millions and millions of people all trying to do it, well, you're going to have hundreds of thousands, maybe even millions, who succeed and think they're smart, when in fact, the evidence shows they're just lucky. Just lucky. You're teaching them to believe that they can do something that even the professionals don't do. Look at the numbers. When you compare the performance of stock index funds against those managed by highly paid people who are getting, 7 figures a year for managing money. They do this for a living. They have access to resources far greater than you or your students. And they, in aggregate, trail their indexes because the markets are so overall efficient. There are inefficiencies, yes, from time to time, but your kids aren't going to be able to exploit those inefficiencies. You really should be teaching them that owning the market beats beating the market, or probably will. In fact, owning the market has beaten the market, and it's a lot simpler. As for resources, I know because they now, for years they've been doing it, but they cover stocks very well. I use Morningstar. I think the data is better than I'm going to get elsewhere, all aggregated in one place. And even the free version, and I see the free version a lot because I forget to sign in, because I really don't need to sign in and use my paid subscription very often. I find the information really, really robust. But I would plead with you to please tell them that picking stocks is a fool's errand. They are going to get false hope. They're going to get, some of them are going to get addicted to literally gambling because of this. I know that sounds extreme, but it happens. It's what Robinhood has been so good at. It's making little gamblers. If you're going to teach financial and investing literacy, you have to teach the academically based reality. And the academics almost universally tell you cannot outpick the pickers. Thanks so much for the question. Remember, you can send yours in at talkingrealmoney.com on the contact form. It is really easy. Just speak it, and it'll end up on one of these fancy Friday Q&A episodes like this one and like this question.
Hey, Don. Hey, Tom. I heard you guys, I heard the desperate plea for calling in with a question, so I figured I better come up with something. Jeez. Here's the question. I use a free app, Empower, to help view all my accounts in one location. Mostly use it for tracking our spending at a 10,000-foot view. Wife and I are in our mid-30s, 2 kids, well on our way to your favorite, early retirement. But really, we do have a plan to turn that free time into giving back to our community. But I received a notice one day from Empower. They'll do a no-hassle free evaluation of our portfolio. Figured what's the worst that could happen? Probably be a good idea to have a professional look at it. We are about 70% U.S., nice mix between large and small companies, 30% international with a nice mix of large developed, small companies and emerging markets sprinkled in too. 100% stocks right now as we're in our mid-30s, still have a decent timeline. They told me after our first Zoom meeting, I was way too heavy in tech, and they'd have some recommendations for adjusting my portfolio. They would take some time, put that together, and schedule up a new Zoom. What should I be expecting for this second call if I take them up on this? Are there any new indexed annuities I'm missing out on? Any fancy whole life policies that would be a game changer for us? Ooh, I also heard Bitcoin could possibly supercharge me retirement plans. But really, what should I be expecting from these guys? I thought we were pretty diversified, had a really good start for our young age. Didn't see the need to concentrate in any one area to try and make up for lost time. Also, if you guys know a company that would also do something like that, free, no hassle evaluation of a portfolio, always open for a second opinion. Thanks.
Yours is the perfect question to end with. We weren't that desperate. Come on. Were we begging? I don't remember. Maybe. I'm embarrassed. That was pretty funny. Yeah. There are several indexed annuities I'm sure you haven't looked into yet. And you could be like the stock car guy, Kyle Busch, and get yourself a nice indexed universal life plan. Bitcoin, I don't know. That may be going a bit too far. And as for another firm that does that gives free consultations, well, I know one that isn't going to try and sell you something. Yeah, I do. Go to talkingrealmoney.com. You can find them. But what is Empower going to sell you? Well, it's hard to say. Most people know Empower because they pay for the stadium that my favorite football team in Denver plays in, and that's because they're based in a suburb of Denver. The name of the company is actually Empower Annuity Insurance Company. Huh? What does that say right there? Huh? What is that? What does that tell you? Empower does a lot of stuff. They do a lot of retirement plans at work, but they are an annuity company. And so my expectations are you're going to get a pitch for some sort of a high commissioned product. That is my guess. You may get a pitch. I don't know if they do investment advisory services. I should have looked them up. And here I'm doing it on the fly. Empower in Greenwood Village, Colorado. I don't see them listed. Oh, Empower Advisory Group. Yes, they are listed as an RIA. And they do have wrap fee programs. They have advisory planning services. They have a lot of different things in their suite of solutions. Let's just look at their premier investing account and see what they charge, because that sounds like probably the most run-of-the-mill of the bunch. That's not the right page. There we go. Okay, they are not. They're not very expensive. They're not. I don't know what kind of business they do though. Here's what I would do. I would get their opinion. And then I would get that second opinion from that firm that you can count on not trying to sell you anything, that we kind of mention once in a while on the show, and you can get to by going to talkingrealmoney.com and clicking on Meet an Advisor. So get the stuff from them and let us take a peek at it. One, it'll be enlightening, but two, like your call, it could be a lot of fun. So thanks for that, and thanks for... At this time of the year, thanks for answering our call for more questions. Gosh, I can't tell you how much we appreciate it. It really moved me to almost fake tears. Almost. Thank you all for being a part of the program. Tell a friend, please. And remember, we're here almost every day talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.
Hey, Ryan Reynolds here for Mint Mobile. You know, one of the perks about having 4 kids that you know about is actually getting a direct line to the big man up north. Mm-hmm. And this year, he wants you to know the best gift that you can give someone is the gift of Mint Mobile's unlimited wireless for $15 a month. Now, you don't even need to wrap it. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.